So recent mortgaged home purchases are now underwater. Early payment defaults are up. Could this lead to future foreclosures? Well, hang tight. We'll talk about that in a second. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is December the 5th. Randy Patrick here, putting the realism back in real estate. Hope you're doing well. Let's get into this right away here. So this just came out today. It's called the Black Knight October 2022 Mortgage Monitor. So Black Knight does produce this every month. I haven't looked at it for a while because, quite frankly, it hasn't been that interesting. This was interesting. That's why we're going to talk about it today. Black Knight, I guess you could say, got some more. They're a data company, obviously involved in mortgages and real estate and stuff like that. A lot of behind-the-scenes software, etc. So they have they sort of kind of got on the radar with all the sort of mortgage monitors and all the forbearance reports that were going on back in the pandemic. So that's why they're still kicking around now. So this to me was very interesting and very indicative of what we've been talking about for quite some time now. And it just goes to show you that eventually all these things, all the stuff that we see, eventually catch up with us, and it will help to change the housing market, for better or for worse, depending on your position. So interesting that 8% of 2022 mortgaged home purchases are now underwater. FHA loans see early payment defaults rise. So basically, you can check it out. Just type in Black Knight and Mortgage Monitor. You'll Google it. You'll find the information. But the highlights here are, despite slowdown in price corrections, equity risk among 2022 purchase mortgages persists, while risk remains minimal among those who bought 12 or more months ago. So really, it's kind of like, hey, when you purchase something recently within the past maybe year, you're at more risk for equity. Why? Because you've been purchasing at the top of the market. So if things change and markets suddenly dip or change in value, guess what? Now you find yourself a little bit stuck. That's the way it kind of plays out. All right, next it says, of all home purchased with a mortgage in 2022, 8% are now at least marginally underwater, and nearly 40% have less than 10% equity stake in their home, a situation most concentrated among FHA and VA loans. So let's just sort of figure that out here. If you purchased a home in 2022, which is this year, so the past 11 months, 8% are now at least marginally underwater. So what does underwater mean? Well, underwater means that you've already lost value since you actually did your purchase. And if you were to sell your home today, the fair market value you get for your home would actually be less than your mortgage payoff, which would put you in a situation. That's just on loan balance, okay? What about things like when you do a real estate closing, all those extra fees and stuff on top of that? So this is where people will get caught when you're buying at the very peak of the market with low down payments. So also it's saying more than 25% of 2022 FHA VA purchase mortgage holders have now dipped into negative equity, with 80% having less than 10% equity. All right, so I'm actually going to show you a little exercise after we go through this about what I call this equity narrative, right? So since the pandemic started and we had all the discussions on delinquencies, forbearance, foreclosures, the whole bit, the narrative that revolved around the housing industry was very straightforward. It basically said, we have so much equity now, there's so much tappable equity, and as a matter of fact, trillions and trillions of dollars worth of equity, that people who are facing foreclosure or in delinquent if they're loan or in forbearance, etc., the easy and simplest remedy to that is to sell your property, cash out all of that equity that you've earned over the past couple of years, and you'll sell your home and you'll walk away. So I'm going to debunk that, dismiss that kind of narrative in a second here. But interesting enough, this is how it has to play out. So, but the point is, more than 25% of 2022 FHA VA loans have now dipped into negative equity. Well, why is that problematic? Well, because as far as I'm concerned, we don't really have true subprime mortgages now. So FHA or VA loans are fairly close to what you would consider subprime. The reason being, there's low down payment, or zero, sometimes even zero down payment, or low down payment, 3.5%. Number one. Number two, the debt to income ratio allowances are much higher than conventional loans. Sometimes very high, and they'll do a little wave rider to let people through. And also in these purchases, FHA, VA will allow concessions. So homeowners could actually get concessions, to bring less money or less closing costs, etc., with respect to like FHA, VA loans allow concessions from sellers. So it's one of those things that, it's a tighter borrower that's going into this FHA, VA loan potentially. And that's how I look at it going, guys. I mean, I want to clarify this too. If you can get an FHA, VA loan, by all means, do it. If it works for you, great. But, we have to always understand there's always the flip side, there's risk, and this is what's happening around. The risk is now manifesting. Now, what we also see here is what's called early payment defaults. Loans delinquent within 6 months of origination have been rising among FHA borrowers over the past year and now sit above pre-pandemic levels. So think about that. You bought a mortgage, you bought a house, and you got a mortgage, and now within 6 months, you're now defaulted and you're not paying on your mortgage. What does that tell you about what's going on in the industry? Okay, what does that tell you about what's going on in our economy? Okay, whether it's job loss, inflation, whatever. When you enter into some of these loans, if you're just squeaking through to get loan approval and you're just making it based on the ratios, when things change or suddenly change in someone's economic, personal household income, finances, whatever, it can make a big difference. And you know what? You're going to pay all sorts of things, food, utility, clothing, your children's stuff, whatever, before you pay your mortgage. It's just, that's the way it works. I've dealt with so many people, so many homeowners over the years and now, so I know that's the routine. And ultimately, this is a warning sign. So we are going through a housing, let's be clear. We had a housing bubble. The bubbles burst. Now we're going through a correction. How do we know there's a correction? Well, every financial house on Wall Street basically is saying that we're in a correction mode. Even the federal government, as I always say, they've said we're in a correction mode. So it's actually happening. This is early indications. Well, not even early. We know it's happening. But this to me is indications that mean we'll be going into crash territory in 2023 because this will increase and manifest its way out. So very interesting to see that this was not talked about, and all these things that people said weren't going to happen are happening now. Okay, simple as that. Oh shit! Sorry guys, I just hit the wrong button there. So hopefully we'll just continue here. Anyway, so that's the scoop on that. So I'm going to the next slide here. I hit the wrong button. I hit the pause button or the finish button. So sorry. Anyway, this is interesting. So among FHA purchase holders, more than 25% have slipped underwater, and more than 3/4 have less than 10% equity. Not good, as I said. We'll show you an exercise on how to look at that. This is an illustrative and unfortunately potentially vulnerable cohort that we will continue to keep a close eye on in the months ahead. So that's the scoop. So really, you think about it. You've originated a loan in 2022, and a certain percentage, 8%, is already not making underwater, and a certain percentage is not making payments. So it doesn't bode well for the future, especially now that things are going to change. Interesting enough, too, I guess you could say the early payment default, EPD rate, which captures mortgages that have become delinquent within 6 months of origination, have risen among FHA loans for much of the past year to reach its highest level since 2009. So there you go, excluding the months in the immediate wake of the pandemic. This ties into the equity risk discussed above as well. Such loans rely on rising home values and principal paydowns over time to gradually improve their equity position. So guess what? That's not going to be good for people, as we mentioned, and that's going to play into how the housing market's going to crash. Now, if you recall, if you've watched my videos over the past couple of years, I used to show over a period of time, there was this FHA chart that talked about the 10 most, 10 worst homes for delinquencies from FHA loans. Well, that was on a monthly basis, and it became quarterly. And there was a time when, we were seeing, a lot of, we're talking, certain locations had over 20% of their FHA loans were delinquent, and a heck of a lot were seriously delinquent too. Well, one day that report disappeared. It came out quarterly, and then suddenly there was some changes in that report, and things looked a heck of a lot better, which as I always say, I believe that a lot of the data is being manipulated behind the scenes in some of these data sets and pools to make it seem like it's not as bad as it really is. But now, as time goes on, I mean, it's going to show it's going to rear its ugly head, and we're going to really see the truth of what's happening in the housing market. So please keep that in mind. And by the way, folks, if you appreciate the information that I provide to you on this channel, if you could hit that subscribe button, I thank you very much. All right, moving on. So we're going to do an exercise here, and this is called Follow the Equity. So this goes to back, as I mentioned earlier, the narrative with respect to, anybody who has a problem, if you're in forbearance, delinquent on your loan, you're facing foreclosure, All you have to do is sell your property. You'll cash out. You'll ride off into the sunset with money in your pocket, pay off those loans, and everything will be great. Well, that's that's very altruistic. And again, it depends on the situation because everybody's foreclosure or delinquent situation can be different. But I'm going to show you what kind of the norm is that I'm seeing. And the reason being because I talk to people. This is our business. I see this on a daily basis. So I kind of know what's going on with respect to what homeowners are doing. So this little thing is called follow the equity. So at top, we have fair market value and we have loan balance. So of course, the narrative has been, well, your loan balance, the difference between the delta between your fair market value and loan balance is so big that you could easily pay that off and walk away with money in your jeans. Okay, now we all know that, okay, once you've done that, you've sold your house, you can't buy a new house because you've had all these late payments, so they're not going to get a mortgage. Now you have to rent, and now rental property has gone up the roof with respect to local rent rates and housing availability, etc. So it's not easy. Out of the frying pan to the fire is what people say. But anyway, follow my example here. Okay, so we're going to move through this in a second. Okay, so when you don't pay your mortgage every month, you don't pay your sort of like it causes you to go into a arrears situation, right? So I know that I'm pretty sure that how they calculate or how the data people calculate what we call tappable equity is they go, well, we look at the loan balance of the home and we look at the fair market value, and that's how we figure out our equity. Well, I don't think when they're doing that analysis, they don't know what's going on in someone's individual mortgage and how far behind they are and how that's actually changed their tappable equity. So realize that every month you don't pay your monthly interest. There's a chunk that's going up. So you have to add that into what you have loan balance, which is your payoff, and the fees and arrears. So the monthly interest becomes an arrear, and you got to pay that off. So every month you miss your payment, that interest component that's part of your mortgage, principal and interest, okay, PITI, principal, interest, tax, and insurance. Well, the principal's not being touched, so it stays the same, but the interest is still accruing, and it's something you have to pay for. So every month that you don't pay your mortgage, monthly interest does increase. All right, guess what? What comes in your mortgage? Well, for most of us who have mortgages that you've probably secured, maybe 2002 or 3 going forward, the majority of people have annual property taxes and insurance escrowed into that mortgage payment, right? That's the TI, taxes and insurance. So principal, interest, taxes, and insurance. Well, every year that you don't pay, guess what? Your mortgage company, your lender, servicer, whoever is taking care of the loan, will actually make that payment on your behalf. So your property taxes are paid and your annual insurance is paid. Well, guess what? That's bang. You missed that. They paid that for you. That now goes on top of what's owed. It's an arrearage. Okay. So guess what? We have every month you don't pay, your monthly interest goes up, goes up, goes up. It's as being due. Property taxes and insurance. So every year you don't pay, that number is going to be added into what you owe on top of your loan balance. All right. So and that's why people who have not paid for 3, 4, 5 years, you can see that number can get quite large and can chip away at your equity. And furthermore, what you're going to find, this will vary depending on your location, state to state, but you've got lender fees on top of that, possibly attorney and legal fees, and administrative fees. So they have valuation, they have securitization, people that go out and do values and stuff like that. So those are all fees that they're charging the loan and adding on to your loan balance. So your loan balance really is principal, all the monthly interest from the day you've not paid up until today and going forward, every year of property tax and insurance, and then all these additional fees that they're going, and it's not they're throwing fees on for fun, but things that they do to maintain and manage the loan and do things that they normally would do in this situation of not paying your mortgage and facing foreclosure. Those are numbers, fees, etc. They're going to be added into typically what is your ultimate final payoff or final judgment amount. So realize that when this is happening, you're chipping away at your equity from the bottom up. To me, this is chipping away at the bottom up. All right, let's go forward now. Well, if people say, well, hey, sell your property. Well, are you going to sell your property? If you want fair market value and you want to tap into all that equity you have, well, guess what? You're not going to sell it off market. You're not going to FSBO it. It's going to be put on the MLS because you want the most exposure to that property. So your fair market value, your real estate agent is going to list that property for you. So great. So there's an offer price and list price. It's out there for the world to see. So guess what? If an offer comes in, what's going to happen? Well, when you get to closing, you're eventually going to have to pay real estate commissions, typically in that 6%, maybe 5%, but typically, so it's 5 or 6% of the purchase price that comes off the top out of the money that you're going to get as the seller. Well, guess what? You've got closing costs. So again, depending on where you are, you're going to have closing costs from title or escrow companies to complete the transaction, maybe an element of title insurance. You're going to have state, we call document or transfer taxes or stamps that have to be paid, plus other things that may be your responsibility with respect to the seller side of the closing costs. So again, that's typically 2 or 3% as well too. So you can see that fair market value number is being chipped downward. Okay, so unlike the loan balance, which is sort of the equity, it's chipping the equity going up, the fair market value is being chipped the other way, coming down, because these are costs that are legitimate that you have to do when you do a real estate transaction. Well, here's the thing too. So if I'm a buyer right now, well, I'm not paying your list price. I'm going to negotiate and try to get my best price possible. So expect that if you have a list price, that the offers that come in will be reduced, or you'll do some negotiation, but the buyer's not going to pay list price anymore. Absolutely not. It's not going to happen. And there may be concessions. So for example, if your buyer does take an FHA loan, they're allowed to ask for concessions, which means those are things like closing costs, items that the seller, meaning you, the seller, could pay for, okay, which further dips into your what? Your equity. So, and when I say buyer reductions, I want to be very clear here too, all right? So, this is assuming that your house is in good condition and that you can sell your house for fair market value. Well, what I've always argued with people is the fact that, equity is not cash flow, all right? So if you're not paying your mortgage, you're in a cash flow situation, a cash flow crunch. You're having difficulty. Understood, right? That's everyone understands that. Well, if I have a cash flow situation, well, guess what? I'm not going to put on a new roof. I can't afford to remodel the bathroom and the kitchens and paint and curb appeal and fix, repair, do things, the pool, whatever, and do all the things that you would normally want to do or try to do to maintain your house or to sell your house, in an upward swinging market to get that fair market value. So the buyer reductions are going to come in, and this is what's not factored. So when we look at ARV, after repair value, fair market value minus the loan balance, that looks pretty big. But when it actually comes down to what the offer price is going to be, and you're subtracting commissions, closing costs, concessions, and then, what's our payoff? Well, loan balance plus all the months of interest, all the, how many years you didn't pay your property tax insurance, and any other fees associated with the foreclosure process, it leaves you with very little margin. All right. So could you have put something in your pockets to walk away? Possibly. All right. Or could you be technically underwater? This is where we talk about this underwater stuff. So homes that are underwater, they're just looking at basic loan balance and equity at this point in time. They don't factor in the realism and the realization of a transaction costs the seller money, number one, and two, a buyer is not going to pay premium for a substandard or a property that needs work, updating, etc. That's just the way it goes. Air conditioners, water heaters, pool equipment, and heaters and pumps. Okay, all those type of things, right? Roofs, bathrooms, electrical. Like you can go on and on and on about is the home and is it functionally obsolete? Has it been updated at all? Like what's going on there? So of course the buyers realize that if they're going to buy the property and live in the property, they're going to have to put money into it to bring it up to today's standards to get to that fair market value. So they're going to reverse that out and negotiate those costs down from the actual list price or factor those in their offer price. So in the end, what does this really mean? It means that you as a homeowner or a seller are not going to get as much as you think, which pretty much dispels or dismisses all this equity rumor when things come down to it. I go through this calculation every day talking to homeowners who think they have equity and think this is great. And we go and check out their homes like, listen, you go ahead and sell it now, but if they don't want to pay commissions and closing costs, they're going to go to a real estate investor, okay, a cash buyer particularly, who will offer them not fair market value and do the same accounting I've done right here. So you see, that's the kind of situation we're in. I don't want to pay closing costs and commissions. Well, great. You're not going to get premium buyers to bring a wheelbarrow full of money to take out your property and take out your problems and not have to pay for that somehow along the way. That's just the way things work in the real estate world, and this is how things will change. So that's kind of my little example here. But to summarize what we've talked about, well, guess what? Looks like we got some underwater properties that are happening really quick once the loans were issued this year. That's probably also going to be affecting the 2020 and 2021 values and loans as well too. But this report kind of focused on 2022, which should be surprising enough to say, hey, we've had this issue, and it's only and these are mortgages that happened or were originated this year, which to me is a really big telling sign of where the market's going to go. So if you want to find out what's going on in your home local market, your neck of the woods, stuff I always talk about, go to gethousingdata.com. That's gethousingdata.com. It's my affiliate link with foreclosure.com. You can check out the pre-foreclosures, foreclosure auctions, tax deeds, all sorts of distressed property in your own backyard, which should be very helpful to validate what I'm talking about. All right. So again, you know what I'm looking for? As I said, I did really want to really get into that today. The number we should be talking about the pivot. Okay. I'll talk about this more next video, but I was actually attended a mastermind event on Friday, and it was an interesting mastermind event. I wasn't in the mastermind. I've been in a number of them with lots of significant real estate minds and investors and the whole bit. And I actually was there to contribute my knowledge based on the short sale world to this group. And the theme of the mastermind was recognizing the market trends and pivoting quickly when the market changes, so you don't get caught and you can take advantage of what's going on forward. Okay, that's what we're talking about here. So that's the scoop. So please reach out to me if you want more information about what we do, how we can help you. All right. So anyway, guys, look forward to speaking with you shortly. All right. We'll have another video this week. And ultimately, in the end, that's how you get a hold of me up there at my email, and give me your phone number, and we'll make sure we connect. Okay. Everyone take care. We'll talk to you soon.